Ladies and gentlemen, good day and welcome to Q2 FY25 earnings conference call of Renaissance Global Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Sneha Kumar Purohit from Renaissance Global Limited. Thank you, and over to you.
Good afternoon, everyone, and thank you for joining us on Renaissance Global Q2 and H1 FY25 earnings conference call. We have with us today Mr. Sumit Shah, Chairman and Global CEO, and Mr. Hitesh Shah, Managing Director of the company. We would like to begin the call with a brief opening remarks from the management, following which we will have the forum open for an interactive question and answer session. Before we start, I would like to point out that some statements made in today's call may be forward-looking in nature, and a disclaimer to this effect has been included in the results presentation shared with you earlier. I would now like to invite Mr. Sumit Shah to make his opening remarks.
Thank you, Sneh. Good afternoon, everyone. On behalf of Renaissance Global, I extend a warm welcome and thank you all for joining us on our earnings conference call for the second quarter ended 30th September 2024. I will initiate the call by taking you through a brief overview of the company's operational and business highlights for the period under review. Post that, Hitesh will give you a rundown of our financial performance. Building on the momentum from Q1, we achieved stable growth across key segments, with quarterly revenue from continuing operations rising 3% year-over-year. Our consolidated EBITDA margin from continuing operations reached 10.3%, enhanced by operational efficiencies and a strategic focus on high-margin segments. Our continued focus on high-quality businesses has meaningfully contributed to the positive impact on gross margins, which are up 434 bps through our margin improvement initiatives. In own brands, our revenue grew by 7% year-over-year in Q2, while the EBITDA margin in this segment reached 10.3%, reflecting a substantial year-over-year improvement of 575 basis points. As we approach the holiday season, we expect strong consumer demand in this segment, setting us up for a promising end to the year. We recently launched a new direct-to-consumer fashion jewelry brand, Renee, to be primarily sold on Amazon in the US. The brand is uniquely designed to meet an ever-growing affordable fashion jewelry demand among millennial and Gen Z consumers. Our focus on branded jewelry continues to drive growth. Recently, we tested the Enchanted Star collection with a major retail partner in the US. This collection, an exciting extension of our Enchanted Disney fine jewelry brand, brings lab-grown diamonds into our offerings, featuring engagement rings and fashion jewelry pieces. Early response has been very encouraging, and we believe that this collection holds strong potential to contribute meaningfully to our licensed brand segment in the growing quarters. In the customer brands division, revenue in Q2 stood at 293 crores with an EBITDA margin of 9.4%, making an impressive 295 basis point improvement. We have taken a detailed strategic review of this business and have identified significant process re-engineering and capacity rationalization measures to boost efficiencies. We've launched an extensive cost optimization initiative towards the end of Q2, which will extend into Q3 and is expected to deliver annual savings of 40 to 50 crores. In line with the same, we incurred a one-time restructuring expense of around 3.5 crores in this quarter. Additionally, we expect to see significant reductions in interest rates as we leverage the proceeds from the sale of our gold business and anticipate a more favorable interest rate environment with recent rate cuts announced by the Fed. This combination of actions will position us to achieve substantial savings while reinforcing our commitment to profitability and long-term growth. While we remain mindful of near-term challenges, our outlook on the long-term potential of our branded business remains exceptionally strong. Our partnerships with iconic global brands, coupled with the expansion of our own distinctive brands with strong focus on lab-grown diamonds, underscores our commitment to connecting with the next generation of jewelry enthusiasts. Our strong partnership with renowned brands expertise in product innovation, design talent, and robust distribution network will continue to drive our growth going forward.
Thank you, Sumit. Good day, everyone. We have reported a stable performance during the quarter, driven by better performance in our owned brands direct-to-consumer segment. In Q2 of FY25, our adjusted total income increased by 3% at rupees 392 crores as compared to rupees 380 crores in Q2 of FY24. On the profitability front, adjusted EBITDA expanded by 42% at rupees 40 crores in Q2 of FY25 versus rupees 28 crores in the same period last year, with adjusted EBITDA margins of 10.3% versus 7.5% last year. During the period, our margins improved, and we expect revenue to trend upwards in the coming quarters. Adjusted profit after tax for Q2 of FY25 stood at rupees 15.7 crores, up by 50% from rupees 10.5 crores in Q2 of FY24. For the H1 of FY25, the adjusted profit after tax stood at rupees 31.4 crores as compared to rupees 24.7 crores in the same period last year. Our branded segment reached revenues of rupees 92 crores during the first half of the financial year versus 78 crores in the first half of FY24, which is up by 19%, demonstrating a resilient business strategy and strong market expansion. Our direct-to-consumer India brand, Uraswa, with a total of 4 stores across Mumbai, Ahmedabad, and Hyderabad, recorded revenues of rupees 10 crores in the first half of FY25. In quarter 2 of FY25, our licensed brand business maintained stable revenues at rupees 57 crores on account of healthy flow of orders from our retail partners as well as the direct-to-consumer segment. It had an EBITDA margin of 16.5%, while our customer brands reported an EBITDA of 9.4%, reaching revenues of 27 crores in Q2 of FY25. Reaching a margin of 9.4% in Q, which is an improvement of 295 basis points. Given the increasing contribution of our brands to our overall revenue, we anticipate a promising rise in our consolidated EBITDA margins, with branded business continuing to be a significant profitability driver. Lastly, in terms of our balance sheet, our net debt to equity ratio stands at a healthy 0.27 as on 30th September 24 versus 0.31 in June 24 and 0.29 in September of 23. Our total net debt stands at rupees 328 crores against rupees 370 crores in Q1 of FY25. And our cash and bank balances and current investments stand at rupees 244 crores, which is up by rupees 58 crores from 30th June 24. In conclusion, we are pleased to have maintained steady performance in the face of challenging conditions. Our solid balance sheet gives us confidence in our ability to navigate these challenges and look forward to stronger results in the upcoming fiscal year. On that note, I would now request the moderator to open the forum for any questions or suggestions that you may have. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We'll take a first question from the line of Kashvi Chankotia from JRK Stockbroking. Please go ahead. Kashvi?
Hello, am I audible?
Yes, but your volume is very low, Kashvi. Can you use your handset mode, please?
Yes, I'm using my handset itself. Can you hear me now?
Little better. Go ahead, please.
Yeah, first of all, thank you for the opportunity, and I congratulate everyone on this great set of numbers. But going forward, can you give a more detailed guidance on how we are expecting the quarter two and the FY26?
Sorry, if I understood your question correctly, you wanted more detailed guidance on quarter three and FY26?
Yeah, so half year, second half, and FY26.
Sure, sure. So, I think we are seeing sort of, a return to growth in all of our segments in quarter two. We anticipate this trend to continue or accelerate going forward. I think that, for financial year 26, I think as the penetration of lab-grown diamonds increases, we see revenue growth accelerating. And this coupled with the cost-cutting measures that we have taken in our customer brand segment, we expect strong revenue growth in FY26 and even stronger growth in bottom line because of our cost-cutting measures. So I can give you a broad outlook in terms of direction. Detailed numbers we're not sharing as yet.
Okay, and so these cost-cutting measures won't affect the brand quality and the attraction that we see in the Gen Zs and the millennials, especially for the lab-grown segment?
Yeah, so a lot of the cost-cutting measures have actually been capacity rationalizations because as the business moves to more lab-grown, we see less labor-intensive product being manufactured, which means that we will be able to produce more value of orders with less manufacturing capacity. So a lot of it is related to reduction in manufacturing capacity and some process engineering. We haven't done anything to impact our sales or the desirability of our brands. We're very cognizant of the fact that we need to maintain revenue growth while, looking at more efficient ways of doing business. So, to answer your question, we're very confident that we will be able to maintain a revenue growth trajectory while reducing expenses.
Okay, thank you so much.
Thank you. Before we take the next question, we'd like to remind participants to press star and one to ask a question. Next question is from the line of Naitik from NV Alpha Fund. Please go ahead.
Hi, sir. My question is, after selling of our plain gold business, you were expecting some inventory easing from, the inventory that was stuck with that business. But, however, we don't see that in the September balance sheet. So could you please help me understand why we don't see that or when will we see that?
Yeah, so I think there has been inventory reduction, which is kind of reflected in the increase in the cash balances. However, the absolute inventory number, obviously, this is the start of the season and, September usually represents a peak in terms of our inventory numbers because we are usually building inventory for the October, November, December holiday season. So we would expect to see a reduction in inventory subsequently, both in December as well as in March. I think that, the inventory increase has been offset by an inventory reduction in the plain gold business, which is reflected in the increase in cash. If you see quarter over quarter, our cash balances have increased by 60 crores.
Right, sir. So, but if I compare your cash, versus your March balance sheet, it's broadly remained the same, while your debt has gone up roughly by 50 crores. I'm talking about gross debt. So, what is the reason for the same? I'm not seeing quarter over quarter, but when we compare it with the March quarter,
So as of 31st March, our cash balance was 188 crores. It's 244 crores as of 30th September.
Right, got it.
And so it's up by 60 crores from 31st March.
Okay, got it. That's all. Thank you.
Yeah.
Thank you. We'll take our next question from the line of Rajesh Golcha, an individual investor. Please go ahead. Rajesh, your line is unmuted. Please go ahead with your question.
Sir. Hello.
Rajesh, can you use your handset mode, please? You're not clearly audible.
8 minutes. Hello. It is clear?
Yes, please go ahead.
Sir, I have two questions. First, what are debt level on which we are paying interest? And second, when can I expect any timeline our company to go debt free?
Yeah. So, our intention is that, we've currently obviously done a preferential fundraise of around 168 crores. So this coupled with, cash flow emerging from our business during Q3 and Q4, because as you know, seasonally, our largest quarters are Q3, and, a lot of the receivables go down afterwards. So we expect a meaningful reduction in debt at the end of FY25. Our anticipation is that 1 year from then, which is at the end of FY26, we expect to be zero net debt.
Okay, sir. Thank you.
You're through with your question, Rajesh?
No, thank you.
Thank you. Ladies and gentlemen, to ask a question, please press star and 1 on your phone now. Next question is from the line of Shrikant Parak from Prudent Investments. Please go ahead. Shrikant, please go ahead with your question.
Am I audible?
Yes, please go ahead.
So my question is that the amount which we have got from the preferential allotment. So what's the exactly the strategy to utilize those funds? What is the ratio for mainly the division between the reducing the debt and for more acquisition, as you have mentioned in investor presentation?
Yeah. So, we obviously we are on the lookout for an acquisition, and we have not identified any acquisition immediately. So, once a fundraise is done, debt reduction will happen immediately. And I think subject to us being able to find an appropriate acquisition opportunity which is accretive and fits into the various criteria, the board will evaluate acquisition opportunities. So there is no immediate acquisition target which has been immediately identified, and we will be obviously thoughtful and methodical with the acquisition framework. There is, however, some amount of upgradation of infrastructure that will take place, which we've allocated, I think around 30 crores for. Other than that, the remainder of the money will go towards debt reduction, and then when an acquisition opportunity comes about and the board feels comfortable, at that point the acquisition will be undertaken.
And sir, by just a heads up, I think you might have said in the previous participant question, any timeline where we are expecting the reduction in a debt level sort of a debt-free company?
Yeah. So as I mentioned earlier, we expect to be significantly lower by about 150 to 180 crores by the end of this year. So the net debt, which is currently at 328, should be closer to 100 crores of net debt, and subsequently by FY26 the plan would be to be zero net debt.
Okay. Thank you, sir.
Thank you. Before we take the next question, we'd like to remind participants to press star and 1 to ask a question. Next question is from the line of Hardik Gandhi from HPMG Shares and Securities Private Limited. Please go ahead.
Hello, am I audible?
Yes, please go ahead.
Hello, sir. So I'm fairly new to your company, so pardon me for for answers and questions which might be repetitive in nature. But what are the key drivers as a company in the AD? What are the key drivers which you are seeing right now, which will help the growth in the coming quarters and years? What are the things going your way?
Yeah. So I think that we've segregated the business into 3 segments, and the 3 segments of the company are our brands, which are our direct-to-consumer brands. There is the licensed brands and the customer brands. In the our brand segment, we are fairly new. It's a 200 crore kind of business, and it was zero up until a couple of years ago. I think that there is a tailwind of lab-grown diamonds in our brand segment, which is gaining acceptance in the US, which is causing the business to grow. And there is also international expansion within our brands that we've planned. Currently, a large part of our brands is in the US. We plan to launch in February in the UK, and there will be some geographic expansion which will lead to growth. In the licensed brand segment, the penetration of lab-grown diamonds is currently fairly low. In one of our largest brands, we just tested lab-grown diamonds, and we've seen, great initial success with the brand. So I think the growth in the licensed brands as well as the customer brand segment will come from the transition to lab-grown diamonds. And in terms of the bottom line, as I mentioned in my opening remarks, we've undertaken this cost reduction and capacity rationalization expenses, and you'll see the expense run rate go down by around 40 to 50 crores annually starting next quarter. So I think the drivers of growth really are in our brands, to summarize: geographic expansion and deeper penetration in our existing markets, and penetration of lab-grown diamonds, which is currently fairly low in the licensed brands and the customer brand segment.
Understood. So that's really helpful. But going forward, I know a lot of people are entering into lab-grown diamond business. So I just wanted to know what are the key entry barriers to entry, and is there something which is niche to us, or is it just that anyone with good capital can start making diamonds, and then they just need to tap the market? Or like how difficult it is for someone to, get into? Because I think Tata is getting into this by one of their subsidiaries.
Yeah. So, our approach to lab-grown diamonds is, one, we're not growing lab-grown diamonds. We are in the business of designing and branding jewelry and selling jewelry in global markets. So all of our sales, a large majority of our sales, are in the Western markets. Our brand in the US is, relatively attractive one, and we're going to focus on, building our brand. We've got a robust direct-to-consumer platform that has grown about 5x in the last couple of years since we made the acquisition. And then in the licensed brand segment, we have an exclusive licensing arrangement with Disney, which gives us a moat and helps us sort of protect the business, because Disney is sort of very well recognized brand in the markets in which we operate. So, our brand, which has been sort of growing well, as well as having exclusive access to the Disney brand name, gives us a little bit of a moat in the branded jewelry segment. Within India, we are going to sort of focus on the premium segment in lab grown, because we feel that at the entry level price point, it's going to lead to commoditization. So the brand that we operate in the US is sort of in the premium space, which we plan to expand geographically from the US to the UK and in India.
Understood. So and just to understand, what when you mean it's in a premium segment, what is the factor that determines it's in the premium segment? Sorry, I'm not aware of the things. So
I think just like any luxury brand, I mean, it's about the marketing, right? I mean, I think that whether you take the luxury space in handbags or in jewelry, it's about what the positioning of the brand is and what the marketing is. So I think that if you go to our brand's website, you'll understand how the positioning is premium, and how we are focusing on an average order value of around 2.5 lakh rupees, which is where we've been successful. So, we're going after the slightly premium customer with premium positioning.
Understood, sir. Understood. And the last question, if I can squeeze in, according to what I've read and everything, going forward, a lot of people are still getting into lab-grown diamonds. So, and from what I've heard, after a point, it will just be a price war which will go. So, do you think that is possible in the future, where just like people mass produce lab-grown diamonds and then the customization, and then it just gets into a price war?
Yeah, so I think in any commodity, right? I mean, whether it is apparel or handbags or any consumer product. I mean, I think that finally the determinant of success in a consumer brand is your brand and your branding, right? It's not just about the commodity and a price war, right? It depends on where you choose to compete and what your brand represents and what are your brand values. So our positioning in the US and here has been to build a brand in the premium space and not to get into sort of commoditization and price competition. So clearly, if more and more people enter, I mean, there will be commoditization at some end, but there is various segments in any consumer market. There is, the bottom end, which is commoditized, and then there is a premium end and the luxury end, which, tends to have its pricing power because of its positioning.
Understood, sir. Understood. That's quite helpful. Thank you from you. All the best.
Thank you. We'll take our next question from the line of Nupur Gandhi from Sequent Investments. Please go ahead.
Hi, sir. Hello.
Yes, go ahead.
Nupur, can you use your handset mode, please? Your audio is not very clear.
Hello. Yeah, sir. I wanted to ask you that in your B2B segment in your licensed brands and your customer brands, how much growth are we expecting or seeing in the next quarter, next half year and the next year, financial year?
Yeah, so I think at this point, I think we are seeing, revenue growth accelerating. I think that I don't have a specific number for you, but, we've been through a 2-year period where inflation in the US was extremely high and consumer demand was very subdued. I think we're seeing a lot of those pressures abating and going away. So, our cadence has been to try and grow in double digits in our licensed brand segment, and which we expect sort of in the coming quarters. Again, without sort of coming up with a specific number and a guidance, I think a lot of the pressures related to inflation are now behind us, and I think that we should see growth in acceleration in revenue growth going forward.
Got it, sir. And also, sir, one more question. You said that in your licensed brands, your growth will come from transition to lab grown. So right now we have a percentage of say 94% natural and 6% lab grown. So going forward, what percentage are we looking at? Like how do we plan to increase the lab grown?
So the 94% that you refer to is in our brands, not in the licensed brands.
Okay.
The licensed brands and customer brands, currently the penetration is only 6%, which we expect to grow meaningfully in the coming quarters and the years to come.
Okay, sir. Got it. Thank you.
Thank you. Ladies and gentlemen, to ask a question, please press star and 1 on your phone. Ladies and gentlemen, to ask a question, please press star and 1 on your phone now. As there are no further questions, I now hand the conference over to management for closing comments. Over to you.
Thank you everyone for joining us on our Q2 and H1 results. We hope to see you guys on the next conference call. Thank you very much.
Thank you.
Thank you. On behalf of Renaissance Global Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.